Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today we're talking about planning and placing options trades according to seasonality trends and cycles. And I'm going to be using a tool on Thinkorswim. It's known as the seasonality indicator. I think this is going to be a really interesting discussion, particularly with October and its kind of spooky reputation looming right around the corner. So really looking forward to this discussion. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. Great to see so many familiar names as always. Hello there, Lori and Melissa, Jay Richardson, Posh, Life in the Fast Lane, Greg, Sharon, Kevin, Andrew, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after this live stream is concluded, we'll enjoy the recording, but be aware that you're invited to join us in the live discussion. If you'd like to be here, this is a Tuesday webcast series. We kick things off promptly at noon Eastern time. And as a great benefit to our live stream attendees, my very good friend Connie Hill is hanging out in the chats. She's going to be addressing any questions that come in during the live presentation that I can't get to, as long as they're not too far off topic. So thanks for having my back there, Connie. And Connie and I would also like to issue an invitation to everybody watching. If you have an account on X, you should be following your favorite Schwab presenters there. It's the best place to connect with us in between these live streams. So you can find Connie on X at Connie Hill CS. You can find me on X at Cameron May CS. So let's get into this discussion. I do think it's timely. Of course, the seasons are constantly changing, so I suppose it's always timely. But before we can get into this, of course, we need to consider the risks associated with trading and investing. Risk is real, regardless of the season, so bear these disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so let's set an agenda for the day. I thought today, with October right around the corner, I think a lot of people's attention is probably going to be turning to, is there a tendency of the markets to behave in certain ways at certain times of the year? And is there a tendency for individual stocks to behave in certain ways at certain times of year? Well, there may be. And for some traders, they like to take a look at history and see if that might assist in guiding the process of planning and placing an options trade. So here's what we're going to do. We're going to use a tool called the seasonality tool on Thinkorswim to take a look at the S&P 500 and gauge what it tends to do. This is mid-September. Let's look forward a month. What does the S&P typically do mid-September to mid-October? And we'll put ourselves in the shoes of an options trader who might be using that information to plan a new options trade. Then we're going to apply that same tool to an individual stock, maybe two or three, to get some rhythm with this tool. But we're going to be planning and placing, finally, an example trade by the end of today's discussion, according to what a trader might see as seasonal tendencies for that stock. All right, so let's go right to the Thinkorswim desktop. So this is the trading software that can be downloaded free of charge from within your Schwab Online account. Let's look at the S&P 500. And you know as well as I do that it's just been charging higher and higher and higher. However, we're kind of fading a little bit today. Could this be a tiny bit of a bearish engulfing candle? Could we be pulling back for the next 2 or 3 or 5 days? Time will tell. Markets could go higher, they could go lower, but to get back to today's theme, what have the markets tended to do at this time of year? As maybe a trader already has concerns that things are overbought. We're just again getting into the mind of an example trader out there. Not everybody sees things exactly the same way, but maybe they're concerned as we move through the latter part of September into that spooky month of October. Is that month as spooky for traders as it is for kids on Halloween? Let's see. So how many of you are familiar? As I go to load up this seasonality tool, how many of you have ever used this tool before? I think I've introduced it one time in the past in one of my recent webcasts. I'm going to show this to you. Let's pop up here. There are some things that we'll need to do probably to make it a little bit more usable. Jim says you look at multiple years. We certainly will be doing that, Jim. Yeah. But let's pop up here to where it says style. And right now we just have a standard candle style of chart. I'm going to switch that style. Let's go from the chart mode standard, and I'm going to switch this to seasonality. So what this is going to do initially, we have two lines here. We have the green line. This is just showing us how the S&P 500 has done this year. So if you look back to April, we know that the S&P bottomed in April, and it's been rallying since then. Here we are trading right up near all-time highs. So what is this red line? Well, this red line is actually last year. This is what happened historically. So what this might allow us to do is we look at, this is September of this year. Here's September of last year. And as we moved into October, it's actually kind of a good October. But has that been the historical tendency over the long term? Maybe some of you are aware of the S&P's kind of nefarious reputation in October. There have been some rough years out there. Not all of them, but what has been the general tendency? So what we need to do, as Jim has already proposed, I believe, is to look at multiple years. So I'm going to switch the time frame of this chart. Let's go up here to a daily 1-year chart, and I'm going to switch this to a 20-year chart. So now we're still seeing how the S&P has done this year. That's what the green line still represents. There are those April lows. Here we are up at nearly all-time highs. But down below, very compressed is the performance of the S&P, not over the last 20 years. We could just do that with a 20-year weekly chart. But instead, this is a 12-month average chart representing average years, average weeks, average days for specific times of the year over the last 20 years, since that's the time frame that we've selected. The problem is it is compressed. It's squished down at the bottom. So we need to expand it. And here's the technique for doing that. So we're going to come up here. Right now, the default, what we call the price axis, that's this vertical axis over here to the right, is just set to automatically generate. We need to switch that to a manual. Now, what that allows us to do when we switch this to manual is we can go down here to the 20-year average chart, the seasonality chart, and I'm going to go above that. Notice I'm positioning, we have little crosshairs that are following my cursor everywhere. I'm going to position the horizontal crosshairs just above the highest point of that red line. And then I'm going to click and I'm going to scroll down. I'm going to drag down, not scroll down. I'm going to click and drag down to just below the lowest point. So you'll notice here's my crosshairs. They're coming up just above the highest point here. Let's click. And as I drag down, it's highlighting. And I didn't intend to do that. Hold on a second. This is okay to see this because every once in a while you'll tend to do this. You click, you need to drag down, you kind of click and drag diagonally. And then we get this kind of weird, useless chart. That's okay. We just need to come back up here. Change this back to auto. It goes back to square one. We can zoom back out and start over. Anyway, so we position our crosshairs horizontally just above the highest point, drag down to just below the lowest point, and it's now going to zoom in just on that average seasonality line. Yeah, we're going to lose the context of what's been happening this year for the S&P 500, but we already know that. So I'm going to zoom in, and now what we're seeing is average performance of the S&P 500, and we can look back over this 12-month time frame and address questions like, what is the strongest month historically for the S&P 500, maybe over the last 20 years? That's actually tended to be, look at July, almost straight up, on average, not every year, but on average, that's been the tendency. If you'll notice back here, moving into March and April has been a strong time for the S&P. The earliest part of November has been particularly strong. But what about right now? As of the time of this recording, it's September 16th. So here is an average September 16th. And what if we move out to the middle of October? What has been the tendency? Look at this. From mid-September to mid-October, there's that spooky reputation represented right there on the chart. So this is an average. It's not a guarantee of what's going to happen in a given year. But if a trader has had a tendency over the last 10 years to, let's say, be loading up on new bullish positions as we hit that middle of September, this has been a tough time for those bullish traders. On the other hand, the market has been providing a bit of a tailwind on average for bearish traders. So with that as a sort of a new context, even with the markets up at all-time highs, could they keep going higher? Sure, they could. With this seasonal tendency, you think some might pair that with these all-time highs and think, ooh, maybe it's time for the markets to take a little bit of a profit. It's just kind of that time of year. Let's go ahead with that assumption. Time will tell what the markets actually do, but I'm going to clear off this drawing. Let's remove this drawing. What he says, is there a way to make this a bar chart? You mean a candle chart? Not a bar chart. So we have a line chart. No, this is it's just a line chart. It just goes with closing values on average. Anyway, but let's switch this up now. I want to look at individual securities, individual stocks. All right, let's see if some of these tendencies persist. How about if we come over here to our S&P 500 watch list? And let's look at a couple of these. What about NVIDIA? Let's just click on the very first one. Ignore these drawings up here. These relate to other webcasts that I've taught. But if we zoom in down on oh, and by the way, I do need to, let me just remove this drawing. Let's switch this to manual so that we can do that zoom. Let's zoom in. And now we're looking not at what the markets have typically done at this time of year, but we're looking at NVIDIA at this time of year. So here we are. We're September 16th. It's right there. Uh-oh. Moving into October, NVIDIA has not moved in keeping with the market's tendencies. It has tended to rise mid-September to mid-October. So if a trader is attempting to align their seasonal expectations for the markets with maybe a seasonal expectation for an individual stock, this might not be that stock. So Andrew says, can I show how to get the seasonality line again? Yep, Andrew, let me do the whole process again. Totally fine with me. So first of all, let me just go back to a 1-year chart. So what we started with here was just a standard candle chart, right? So to get that seasonality chart, it's a chart style. So I call it an indicator or a tool because it's an interpretation of what's happened historically. Anyway, I'm going to go up to style. Let's switch this from just our standard candle chart to the seasonality chart. Now, this gives us 1 year of history. What I next did is switch this to 20 years. And then in order to zoom in on that 20 years, we switched this so we could do a manual zoom. That's it. That's where we find ourselves right now. All right, so NVIDIA, nope, it doesn't align with our traders' hypothetical expectations for mid-September to mid-October. How about Microsoft? Let's come up here. Let's do a manual zoom. Ooh, interesting. Here is September 16th right there. And yep, moving into October, there is that bearish tendency. There are times of the year when Microsoft has been quite bullish. By the way, even for the S&P 500, for traders who think, ooh, Halloween is spooky, what did the S&P actually do mid-October into the end of the year? There was a bullish tendency over time, all right? So I could repeat this process a few times. I've already done it. We've looked at a few symbols. Let's go right ahead, start planning an example trade. So one that I found pretty quickly this morning as I was preparing for the webcast was Procter & Gamble. Let's switch this up. Here's what, well, first of all, it can be important here to keep an eye on what's been happening for the year. And I can see with Procter & Gamble, what kind of a year is it having? In this fabulous year for the bulls, he has been struggling. Down and down and down. It's recently pulled up to a high, but could anybody maybe envision, is it maybe at a resistance point? Could it be set to turn down despite recent strength? A technician might have that indication already, just looking at a yearly chart without any seasonal biases. But what are those seasonal tendencies? Let's switch up a manual view. Let's zoom in, zip down. And boy, I'll tell you, mid-October through the end of the year, Procter & Gamble has been particularly strong. But actually, at this time of year, mid-September, let's draw on a line here, down to mid-October. Yep, a fairly pronounced bearish tendency. So here's a stock that we just saw in a 1 year. It's already been working its way down, maybe come up to a resistance point. The S&P seems to be entering the potential for a bearish time. Our stock, Procter & Gamble, seems to be entering a potentially bearish time. Let's go ahead with a bearish trade. But I do think it's interesting. If we were to look at the rest of seasonal trends, boy, when the year kicks off, it tends to get off to a slow start for Procter & Gamble until about mid-March, at which time we see an early spring rally fading into summer, strengthening toward fall, fading through as people, I guess, are gearing up, buying their Halloween costumes, getting worried about what might be around the corner. Yeah, a bit of a bearish bias there, but then real seasonal strength moving through the rest of the year. Now, again, all of these are historical tendencies. They're not guarantees for how things are going to play out this year, but let's just remove this drawing. We've sort of made the premise for this trade. And even in the middle of an extremely bullish market, some traders might go ahead with an occasional bearish trade, a little counter trend trade at times when they think the markets might pull back. Now, obviously, we'll see how that goes. But I'm going to switch this back up. Let's switch our style back. Go back to a standard chart. You can see there's that line that I drew using the seasonality chart. It's still there on my standard chart. And we're back to a 1 year view. So let's plan and place a trade for Procter & Gamble, right? So let's go to our trade tab. Now, when a trader, for those that are really new to options trading, this is a webcast series. I try to go at a pace that everybody can follow. When a trader is bearish, there are a couple of basic approaches to planning bearish trades using options. We can buy puts, that's a bearish trade, or we could sell calls. Now, there are all sorts of variations on those themes, but what we're going to be doing today is based on selling a call, and it's known as a bear call spread. So let's map out a bearish call spread going through. So this is going to be done by the 10th of October, one way or the other. So that's during that time frame that we saw the S&P has a bearish tendency. The Procter & Gamble has that bearish tendency. So let's stay here with the 10th of October contracts. And if you don't know how we found that, go to the trade tab, enter our symbol, and then right down on that trade tab is what's called the options chain. And these are contracts that's standing out from 3 days, potentially as long as 857 days. So we're going to stick with the time frame we've been discussing. Let's go to let's see, actually, let me check something here. We might even go out here to the 17th of October. Let me just double check. Yeah, no earnings announcement before the 17th of October. Let's push this out to that traditional third Friday expiration. Those contracts just tend to have maybe a little bit stronger liquidity than the weeklies. Terrence says, why would you sell when the volatility is so low? Yeah, Terrence, it's a good question. When the markets are this strong, in other words, the markets are not terribly volatile right now, options tend to settle down in price. Now, for some traders, they would describe that as more of a buyer's market. We're actually going to be selling. What we're doing in this trade, though, is we are both buying and selling. So that volatility has a pretty muted impact. And interestingly, if we did credit spread versus a debit spread, because we might think, oh, let's buy. It's a buying-based trade. It would have a more favorable volatility scenario. Nope, it's actually effectively an identical trade. Not exactly, but pretty similar. Anyway, yeah, bit more of a buyer's market. The way that can impact this sort of a trade is when stocks are not highly volatile, it might require that we choose strikes that are closer to an at-the-money position to try to get maybe what the trader prefers for maybe their preferred credit. Anyway, so let's go. Wiley says, how will dividend stock react to the rate cut? So yeah, Wiley, maybe Connie might have a couple of points offer on that. I won't get, that would take us off topic. I tend to try to keep my webcasts directly on track, but good question. Anyway, let's go build our trade. So I am going to go to the 17th of October. Those contracts just tend to have a little bit narrower spreads between the bid and the ask price, greater liquidity as compared to the weeklies. Nothing inherently wrong with the weeklies, but I'm just going to go with that third Friday, the 31-day contracts. That's still right out to the middle of October. And here's what we're going to do. Let's sell, how about with the stock trading at 157-ish? And what are we looking at on our chart? Yeah, interesting. Okay, so recently there appears to have been a price ceiling for really almost every moment of every hour for the last 3 months. The stock has pretty much refused to go above 160. It's stuck its nose up there for a moment here or there over the last 3 months, but every day we've settled back down below 160. So let's make this our premise for our trade. Maybe our trader just thinks the stock is likely to continue going down, or could wander upward, but as long as it's below 160, let's structure a trade that would be in good position to benefit from just being below 160. Chuck says you're at a support level. Yep, Chuck, when we're trading in the middle of some choppiness, there will appear to be some support levels. Support could be fine as long as the stock doesn't rally too high. As long as we're below 160, this trade should be just fine. But obviously, if it goes above 160, that'll raise the risk of assignment of what we're trying to do here. But let's look at the bearish trade that we're planning here. We're going to sell the 160 call. And the specific trade that we're going to do, as I mentioned, is known as a bear call spread. So here's how it's built. Our example trade is a bear call spread. Conceptually, it begins with selling a call. So we're going to sell the 17th of October, 160 call. And that looks like that's trading for between 252 and 259. Let's call it 255. Let's say that we're able to collect 255 for that. And at the same time, we're going to buy the 17th of October. We're going to buy a higher strike. And in this example, let's just go $5 up. Let's buy the 165 call. And that looks like it's going to cost us between 95 cents and $1. Let's say that it costs us the full dollar. Just to use nice round numbers. So what exactly is the trader getting themselves into as they're entering into this position? Well, first of all, we're collecting. Again, we don't know how much we're going to get if and until the orders fill. But let's say we get $2.55 per share on 100 shares on this contract. That'd be $255 that somebody is paying us. So we're collecting $255, but for the next 31 days or through the 17th of October, someone else has the right to buy shares from this trader for $160 per share. Now, the trader probably does not want to sell those shares. As a matter of fact, we don't own any shares of PG in this example portfolio. So what we're instead, the real motivation here is to collect the $255, hope that the shares are never worth 160, because if they're worth less than 160, there's little motivation for somebody to actually pay 160 for them. And that contract hopefully just expires worthless after 31 days. And we keep our 255. That's what the trader's hoping for. However, that may not happen. If the stock rallies up, we have to sell shares for 160, maybe worth a lot more than that. Where are we going to get our hands on some shares? Well, this second contract gives us the contractual right to buy shares for 165 if we need them. And in exchange for that right, we paid $100, $1 per share on 100 shares. So that sort of defines the upside risk potential of this trade. If we have to sell shares for 160, at least we know we don't have to buy them for more than 165. So that defines the risk, gives us a theoretical maximum loss on the trade of $5 minus the credit that we collected. So we are net credit here is also equivalent to our theoretical maximum gain on this trade is $1.55. That's $2.55 collected minus $1 spent. Parents, you want to show the volume and the open interest? Sure. Now, even as I go to do that, though, Terrence, because I know what you're talking, what Terrence is asking about here is, I wonder what the liquidity of these contracts are. What's been the volume of trading today on the specific strikes that we're thinking about? And what is the open interest? In other words, how many open contracts are there already at the 160 and the 165 strike? Each of those are different measures of basically the same thing, which is liquidity. There's already something on our screen that's strongly hinting that these contracts have very good liquidity. What is it? Without even looking at volume, without even looking at open interest, some traders might already be perfectly comfortable with the liquidity scenario here. Here's the situation when we have a very narrow spread between the bid and the ask. These are penny increment options. Notice 252 to 258, those are pennies. That's a strong indication of liquidity. But if we want to add those, let's come up here. Let's borrow maybe the Delta Theta Vega. Let's switch that for volume and open interest. Yeah, Kevin, Greg, Jay Richardson, Jason, Vic, Melissa, all saw that spread between the bid price and the ask price pretty narrow. That's quite a bit of volume for an individual strike price on a contract and open interest. Some traders have a personal rule regarding how many contracts they're willing to trade in relation to how many contracts are, let's say, represented by open interest. For some traders, they might say they don't want to trade more than 5% of the open interest, as an example. So that would be how many contracts? If we have, 8,500 here, 85 contracts would be 1%. I'm not going to trade 85 contracts. All right, but yep, there we go. So let's switch this back. Come back up here. Let's put our Greeks back on here. Matter of fact, I'm going to customize this column set. I'm going to take gamma off for now. There we go. All right, so this is how much the trade might make. How much could the trade lose? What's the theoretical maximum loss? Could lose $5, but we did get paid $1.55 to set this thing up. So after accounting for that, it leaves $3.45 of risk in this trade. Okay, so yes, this is a trade where there's a smaller reward potential than risk. That's actually very common for higher probability scenarios. For example, if one were to invest in a long-term government bond, we know that we're putting up a ton of cash and in return getting a relatively small amount of money in return. Well, it's because maybe that investor is comfortable with the risk that the government's not going to default over, the period of time of that loan, basically, of that bond period. Well, similarly, if there is a higher probability of success than failure on options trades, very commonly, there is a lower reward for being successful. S says, where did you get the $5? Well, S, if these contracts, ultimately, if we're assigned at 160, we have to sell our shares at 160. And if we decide to exercise our right to buy shares for 165, well, if we buy at 165 and we sell at 160, that's a $5 loss, right? We still have $1.55 in our pocket, leaving $3.45 net lost. That's where that equation comes from. How do we make the $1.55? Well, hopefully, both of these just expire worthless. If the stock, let's say our stock remains bearish, even going back to the proposal here, well, maybe we bounce off support. What if we go up here, hit that resistance, and we still move down? Well, as long as we're below 160, put yourself in the shoes of this trader who has the right to buy shares from us for 160. Let's say the shares are only worth 157. Is the other trader going to overpay and say, Cameron, out of the kindness of my heart, I'm going to pay you 160 for the shares that are only worth 157? Nope, they're probably just going to walk away, Cameron, keep the shares. I don't want them. And as they walk away, guess what we realize as a gain there? We're keeping that 255 that was collected. That's a 255 profit. Great. But we also have the money that we spent on this call. If the shares are only worth 157, and we have the right to buy those shares from someone else for 165, we'd be overpaying as well. So that contract expires worthless. We lose $1. We make 255. The net is 155 if the stock is below 160 at expiration. Where's the worst case scenario? Well, if it's up above 165, that's up here. Let me draw in a line at 165, right about there. So let's just clear things up a little bit. Let's remove this drawing. Let's remove this drawing. And let's say that despite our conviction that the stock should be going down, well, we have trend line down. The S&P is entering a bad period historically. The Procter & Gamble has had a rough patch typically around this time of year. Well, despite all that hard work, is it possible the stock could just do this? Could it just go straight up? It certainly could, yeah. And if the stock's up here above 165 and someone has the right to buy shares from us for 160, are they going to do it? Yeah, they're going to do it. Very, very rare exceptions. Buy the shares at 160? Oh, no, we have to buy the shares at 165. We buy at 165, sell at 160, it's a $5 loss, minus the $1.55 premium collected up front or credit up front, leaves us with our $3.45. This is our no-fly zone. We do not want to be up here on October 17th. Let's draw in a red box up here. Okay, put in a red box right there. Where we'd like to be is down here. So we're going to put in a green box down here. And I'm just drawing these boxes in. People ask where these boxes come from. I just drew them in. Another potential scenario is that it goes above, let's say our stock rallies, but doesn't get above 165. Uh-oh. In that scenario, somebody might buy our shares for 160. So now we're short shares. We don't want to overpay for those shares at 165, even if we have the right to. So in this case, the trader may wind up short shares. That means they sold shares that they didn't own. The contract that we thought was protecting the position just expires worthless. And now we have exposure to a short stock position, which has unlimited risk if the stock continues to rally. So be aware of that. All right, so Chuck says, what's the best way to exit if the trade is not going your way? Do we leg out to try to make up some losses? Chuck, best is always discovered in the rearview mirror. We don't know at the moment we're making those decisions. So I can't say what's best. There are lots of choices the trader might make. If the trade is failing, yes, we can try to get fancy with it and close out a part of the trade and hope that the remaining part does better than it was before. That's not a guarantee, though. So legging out, which means closing out some of the position, like closing out the short side or closing out the long side, and hoping the remaining position can make up for losses, might happen. It might not. Okay. Anyway, good question though there, Chuck. So let's go ahead and place a trade. I do have a webcast series where I talk about the management of these sorts of trades down the line, but what we'll do here is let's just put in a stop order for this trade. If it starts to misbehave, we're going to let it work if it's working. If it's not, we'll draw a line in the sand. So let's go place our trade. How do we place the trade? Well, a quick way to do that on Thinkorswim is come up here where it says spread single, and I'm going to change that to vertical. And so now we can see there's our 160, 165. It pairs up the strikes with each other. So now to sell our vertical spread, we're looking to get a credit. So we're selling to get a credit. Let's click on the bid price. So this is going to create an order to enter into 10 contracts each of the 160, 165. And let's assume, let's see, we were looking to try to get $1.55 here. Let's put that in as our minimum acceptable credit. We'll enter that as our limit, the least we will accept. So what we're really hoping for here is to collect the 155 and for these contracts to just decay away until they're eventually worthless. That would be the best case outcome. But what Chuck is asking about is, what if it's not doing that? What if through whatever combination of factors, instead of this going down in value, it's going up in value? It's not good. Let's enter and exit to get us out if we start to increase in value. Okay, so here's how we might do that. First of all, we might want to calculate how many contracts the trader wants to enter into. And if there's $345 of risk per contract, we just tailor that to be in line with how much the trader is willing to risk overall. So let's do 10 contracts. That would be, instead of $345 of risk, that would be $3,450 of risk. But I'm going to change this from a single order to what's called a first triggers sequential order. If our first order fills, it's going to trigger a second or a sequential order to go into effect, and that's going to be our exit order. So I'm going to right click now, and I'm going to create an ops order. So this one's to get us into the trade. This one is to get us out of the trade. And this is to get us out if the trade is failing. So here's now lots of ways that traders might choose to enter this. Let's just suppose the trader's objective is to go from 155 down to zero. That actually, we'd like to see this credit that we've collected. We don't want to give any of that back. So we like this contract to go down to zero. Well, what if it doubles? What if it were to go up to $3.10? It's not all the way to 5, but it's moving in the wrong direction. If it were to cost us $3.10 to get back out of this trade, we will have lost $1.55 rather than gain $1.55. Let's put that in as our line in the sand, and we're going to call that a stop order. Stop the bleeding, get me out if this vertical spread is increased in value to $3.10. And I'm going to make sure that's a good till canceled order. Let's see. Jim says, can a trader add features to a chart for each trade like you did and save them, be able to retrieve them again with them? Yeah, Jim, those drawings that I just made are just going to stay on the chart. Even if I close down Thinkorswim, I come back and I load up a chart of PG again, it pops back up. As an example, we took a look at another stock earlier in this series, earlier in today's webcast, and you saw some drawings that I made previously. Those I made, I don't know when, a week ago, a couple of weeks ago. Yeah, until we delete those drawings on the chart, they just stay there. Don't even have to save them, they just stay. All right, so let's click confirm and send, and we're going to sell 10 of these verticals. Interesting, this is a bearish trade at all-time highs on the markets. Do you think I have any concerns about this trade not working? Absolutely. Fortunately, it's a simulated trade, no real skin in the game. But we're looking to collect $1.55. We'd like that to decay away to zero. If it's not, though, we have a stop in place at 310. A stop is not a guarantee that we'll exit at 310. We may have to pay more than that. That's just a trigger. Now, due to potentially wide markets or liquidity risks at the time of activation of that stop, this order may be manually substituted with a limit order upon activation and worked until filled. Now, there are commissions to be paid, a total of $13 to get into this trade, a total of $13 to get back out of the trade if that time comes. But let's send this order off, and we're in. We asked for a minimum of $1.55. We actually got $1.57 credit. All right. So, guys, I think the vertical spread was an interesting part of the discussion, but really the primary motivation for this discussion was using that, how a trader might use that seasonality tool to gauge market tendencies and stock tendencies at different times of year, and how they might connect that to the planning and placing of an option trade. So if that was your first exposure to that seasonality tool, hope you enjoyed it. It's not a promotion for the tool. I just want people to be aware of what's available on Thinkorswim so we can trade according to our own preferences. All right, everybody, this is what we do on these Tuesday webcasts. So if you'd like to join me next Tuesday for another discussion, we'll pick another topic and explore that in good detail. But I also have other webcasts all throughout the week, every single day of the week on a range of topics. You're certainly invited to join me in those. I do have a couple of suggestions for you to get the most out of your Schwab education. Make sure that you're taking full advantage of all of your resources. So number one, outside of these live stream discussions, make sure that you have subscribed to the Trader Talks channel on YouTube. So Trader Talks Schwab Coaching Webcast is our channel name. You can go down the lower right-hand corner, click on that subscribe button. It only takes a second to do that. It doesn't cost anything to do that. But our channel is where we house the playlists for previous webcasts. You can also join live streams right here, and you can do searches for topics of specific interest. This will search through our archive of previous webcasts. We have hundreds of them. Now, another thing that I would suggest you do is to follow Connie and me on X. It's really the very best place to connect with your favorite presenters in between the live streams. So you can find Connie on X at Connie Hill CS. You can find me on X at Cameron May CS. And this is where, I'll post questions about the markets and get your input. We can have some back and forth. If you reply to one of my posts, I'd try to reply right back to you. Today, it was more of a sorry to hear about the passing of Robert Redford kind of a post. Yep. Another pop culture icon has passed. But Robert Redford actually had a huge impact here in Utah with his Sundance Resort and his film festival. It's had a big impact on our local economy right here. So yeah, tough to see Robert pass on. So I asked, what's your favorite movie? We do that sort of thing too. But yeah, best place to connect with me is right here on X. Everybody, thanks for giving me your time today. Connie, thanks for helping out in chats. Thanks to everybody who's already clicked the thumbs up button. That's always appreciated. It's a pat on the back to your presenter. But when you hit that like button, it also gives a boost to the presenter's webcast in the YouTube algorithm. Helps more people find these discussions and learn about things like using the seasonality tool on Thinkorswim. You like that one, Dragon Rider and Beto? You're welcome. All right. I will see you in a future webcast. Everybody, I also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.